New visitor.
Thank you. Thank you. I can't hear.
New visitor.
Yeah. Let's see. Try these. There we go. Testing. Oh, wow. All right. I'm going to assume everybody can hear me. Let's check mics. Okay, that's good. Everything looks good. All right. How you doing, friends? This is Ernie, and this is the final hour to expiration trade. And today was a Fed day. It's actually not like a full Fed day. It's just the minutes and then whatever narrative that they decide to put out for investors and traders to chew on to try to come up with future expectations. And, you know, with this market, it's all about expectations. So you may wonder why does the market react the way it did initially to the Fed numbers? You know, initially the market went up on this news that they were going to continue raising hiking rates, and that would go on for some time, and they expect more inflation and more pain. And the market goes up. It makes no sense. So, you know, you try to piece it all together. You try to read the narrative, between the lines and figure out what in the world are they seeing? What does the market see that, you know, the average Joe doesn't see? You have to think that, or put yourself in their place. They're always thinking ahead. And what is this going to mean in 6 months? Is it going to mean that we're going to roll over, or rates are rolling over, or we're in this idea of peak inflation? You know, and of course, from their point of view, it's all guesswork. And from the Fed, of course, they're guessing too. They have no clue. That's tough to say because, you know, it's filled with a bunch of guys and gals that have incredible credentials and education and all of that stuff. They're supposed to have their finger right on the economy and understand it all. But we also know that they are political too. And even though they profess that they're an independent organization and they're not political in any way, they are 100% political. And it's not just one party. It really depends on what party is in power at the time. They'll placate that party as best they can and do their bidding, monetize the debt that they create through government spending. That's what they do. And all the while, they're trying to convince us that they're doing things in our best interest. It could be that they have this sort of dual mandate, you know, supposed. They have a mandate for us, and then they have the mandate for their keepers. And so trying to play both sides of the fence like that is really just an impossible task and an untenable solution, situation. So I don't know. You know, maybe the markets will start diving now. I think that the market is as confused as everybody else. You know, the initial reaction, I don't know that you read much into it. And, you know, I looked at the Newswire and I looked at 3 different sources. I looked at Bloomberg, Reuters, and Fox Business, and the 3 of them had completely different takes on what the Fed said. Completely different. Well, I didn't read the articles, but the headlines were obvious. So you got to wonder. I don't think anybody really knows what's going on. We're in a sad and sorry state in this economy. There's no getting around that. This whole narrative around a tight labor market is just a pile of crap. It is. It has to be. Well, anyways, we're here to try to not really make sense of it all in a big picture. We only care about this tiny little slice of time, this final hour, this final 45 minutes, actually. Or maybe by the time I stop talking, it ends up being about 30 minutes. Oh, it's crazy. So I know that we have way more people there on the chat, but we have 2 people saying hello. How you doing, Jamie? Nice to see you. And Chris. I'm sure now that I've said hello to them, everyone else is going to pile on. But anyways, yesterday we had a non-call. It was just difficult to call. And so today, well, yes, we have Iz. How you doing, Iz? A lot of the usual suspects aren't here yet. There we go. They're going to start, piling on. There's Juan. How you doing? And Hans. Enzo Caputo. I like that name. It's a cool name. It sounds like either a foreign movie star or. Okay, we got Jamie. How you doing? All right. Now, I'm not going to try to make sense of what the Fed's doing. Based on the market. It's just I don't know. It's a hot mess. It's just hard to understand exactly what is going on, and probably the real reaction won't happen until the next few days, and it might take a few days for the market to digest it. It's really hard to look at it and say, oh, it went up about 15, 20 points, and then say that that's the reaction. The real reaction is what happens over the next few days. All right, and right now, most of that reaction that caused the market to go up, man, I can't talk. That caused that reaction of the market going up has been cut down now. I mean, let's just take a look at what we have here and see if we can make a trade out of this. So, yeah, you can see here. Now, one might say that my analysis was spot on. Because if you look at my analysis was, hey, I think we're going to go up and then come right back down. So that's what this is right here. And I wasn't sure if we would go up to this LVN, the green line, or up here. Now, this scenario analysis that I put in here, I usually draw these lines in before the economic reports come out early in the morning. So I do that every morning. I'd say I'm probably about 75% correct most of the time, with very in a very detailed way, by the way. So I'm thinking that this path right here, this outer path, is really what we're going to follow. And so we went up, we're going to go down, we're going to end up somewhere down here, close to, in my view, close to the T0 node. All right, so let's take a bigger picture view of this. I don't know why why is this headphone not working? Hello. Just not there. It's not there. Oh well. Maybe this one. I have a couple of them here. Maybe it's this one. Hello? Nope. They're all offline. I don't know. I'll look into that later. All right. We'll look at a longer time frame and see if we can make some sense of all this. If you were watching earlier this week, every Monday morning I do a clean slate volume profile analysis. These red areas here are actually long-term volume nodes, and then the area between are what we call LVNs or volume wells. The green lines are the very lowest point of volume within those volume wells. Of course, that changes a little bit as the week wears on and we start getting some filler in there, but they still seem to hold very well in terms of providing support and resistance. All right, so let's zoom out a little bit more. All right. So Here's this really magnificent bullish run. We've come short of this T2 node. This T2 node up above here is really quite significant. And that is because if we were to make it up there, that's a place where you could develop a rather good base for much higher prices. And I think that that is a monumental thing if, in fact, we turn around here. One way to look at this, and this is the way I'm looking at it, as we were moving up, let's go to a daily so it's a little easier to see. All right, so here's the T2 node up here. Huge amount of volume. If we were to capture that, I think that it would be a lot easier for the market to move higher from there. But by not capturing it, I think that there's a good chance that we're going to go down harder. Now, if you were to look at the way prices behaved on the way up there, all of the impulsive moves, they started out pretty strong. Big impulsive moves with consolidation, impulsive move consolidation, impulsive move consolidation. But as we went higher and higher, the impulsive moves have gotten smaller and smaller and smaller, and the consolidation shorter and shorter. And now we're at what looks like the apex of that move. And yesterday, I had even said this online, that yesterday's reversal late in the day looked like some sort of capitulation by the market. They were done. That's as far as they can go. They don't think that they can push it any higher. And then the Globex market, the overnight market, the market came down pretty hard. Maybe in anticipation of maybe front-running whatever the Fed was going to put out. That could be. And maybe if the Fed put out something that wasn't maybe as harsh as they thought it could be, and that could have been a reason why the initial reaction was for the market to push up, but then better level heads set in, and they thought about it. They digested more of that. Their AI took over and analyzed all the linguistics, and then now it's starting to come down. So I think that's how I would assess it. And so I think that we are coming down from here. I could be completely wrong, but that's what I think we're doing. And I think we're going to try to get to this T0. You say, hey, what is T0? It's like sitting out there in nowhere lands. But it is there if we bring over more data here. And you can see there's T0. It's actually kind of part of T1. But it is there. And we have this tiny little, well, it's not really a tiny, but there's a gap here, low volume node. And it is definitely an area that the market doesn't want to stay in here. It wants to either go to T0 or T2, either down or up, one way or the other. And to me, it just doesn't look like it can make it up to T2. So I think it's going back to T0 and ultimately T1. And then if the market is going to behave the way you think it should behave based on the economic condition, then we should naturally drop through this huge volume well and LVN and then move much lower and maybe make new lows. So I know that's a long ways from here, and we've gone up a long ways. I think somewhere around 18% move, which is incredible. I mean, normally the S&P doesn't even move that much in an entire year. Yet we did that in just a few weeks. So that's the way I see it. That doesn't make it any easier to day trade this, to tell you the truth. All right, so we have a little bit of indecision. We do basically have wiped out that initial impulsive move up and come back down. But now the market is kind of in between, doesn't know what to do. All right, let's zoom in a little bit more. So if we were to take it from this point of view, to me, it looks like 42.75 is the predominant node here for the day, where most of the volume is. Let's see what... Yep. Let's see what's on the options chain. On the put side, we have a pretty big voluminous strike at 42.50. You can see that it's just at about 50,000. And we don't have, well, we have one comparable one on the call side that's much bigger, 86,000 at 4,300. But that ship has sailed, it seems. We went up there and then turned around. So now it appears that we were going down. We could be just, taking a little breather and come right back up to that 86,000 or what is 4,300. But the momentum now seems to be down. And so that's where I think we're going. I think that we're ultimately going down here. And I do have a strategy down here, as you can see. It's cheap, very inexpensive, low risk, and if it happens to get down there and meet up, then it could mean something. All right, so we have a few more people coming on. We have Jim G. How you doing? And Donald Steele. How you doing, Jim Seraphin and Will Do? And you guessed, maybe play for return back to the high of the day since inexpensive. Yeah, but that's not a good enough reason just because it's inexpensive. We have criteria for how we actually get into a trade, and it's not based on how inexpensive it is. We do take low-risk trades, but we don't put them on for the sake of putting on low-risk trades. Donald says he took a Batman trade today and won on the top waiting for the drop. Well, that would be sweet to win both sides. Jim says maybe 42.60. Yeah, that's about where I'm thinking as well. 42.50 is the big kahuna on the put side, and it remains to be seen if we're going to move down there. We're only a few strikes away. 1, 2, 3, 4, 5 strikes away, so anything can happen. And let's see. Clayton is here. How you doing, Clayton? And John Miller. All right. And check out the put volume. All right. I think I just did that. So it looks like we're vacillating here. And we're at 3:30, so there's not a lot of time left in this market for something to happen. And, if I had to guess, I would say that it's right on this volume node right here, 42.75. That looks like the most logical place, 42.75. And with the movement today, the movement in the Globex market way down, and then the pop and drop here with the Fed, I'm not really willing to bet a lot on this, but that's what I'm going to say. I'm going to say 42.75. Let's see what a trade there looks like. That'd be tough. That's like right there. We'd have to go to 42.70. Otherwise, we're not going to get the pricing. Yeah, it looks like 5 wide is about the best we can do. That's really not a great trade. It's actually not too bad if you can get it for just over $50, 55 cents or 60 cents. At 60 cents, the potential for a 5 wide is only $500 minus there. It's about $440. That's about a 1 to 6, 1 to 7 risk to reward. I'm going to step aside on this one today too. And if you were to put on a trade, I would think that meets our criteria, by the way, for a trade like this. And the criteria for a trade like this, first of all, is that we want to put on something that has minimum of 1 to 5 risk to reward. We prefer anything from 1 to 6 to 1 to 9 risk to reward. And if we can find a trade where the probability of touch of the near side long leg is at least, let's say, 65%, and the center strikes at about 40% or better, then that gives us the kind of confidence that we need for that trade. And those odds tend to work out. Of course, it helps if we have the momentum behind our backs and there are volume structures that will support that. In other words, there's like support or resistance or other things that might make price gravitate towards one or the other. So that's what I think. I think without actually taking a trade, I'm going to say 42.75 wide. See, I don't think that we can do anything wider than that. If we go wider, it's going to be way too expensive. Let's see. Yeah, way too expensive. Yeah, the risk to reward just isn't there for anything wider than a 5 wide. Wow. Yeah, it doesn't look that bad. It's starting to move towards this center strike, towards this POC. Really hard to tell what the market wants to do here. But that would be my guess. Probably going to land right on this POC. So if you can get a good price for anything that overlaps this POC, I think that would do it. But I don't know. It's just too close for me. I mean, I'd like to see it just drop hard and go right to the volume node below. I mean, that would make more sense to me, T0. This is also right at that area where last night's move kind of culminated. So there might be something about this area here. I don't understand it, but that's my call. I think that we're going to end up right there at 42.75. But I'm not trading it. So it's going to be another no trade for us. Well, at least for me. So let me explain a little bit about what this trade is. The 0 days to expiration trade. In particular, this variation of it, the final hour. This is an experimental trade for us. And we perform these experiments over time. And what we'll do is put 50, 100 trades at that to try to prove it out, or to try to find out what are the rules that we might want to put around that type of trade, because we saw some benefit in trading this final half hour. And in fact, the first 50 trades. Now I had allotted 100 trades to do, and I'm doing that out in the public and letting everybody see it. We did the first 50 trades and they were wildly successful. Made a lot of money on that. And then the second 50, we've started out, we're 20 trades into that. And it's been flat, really. After 20 trades, I'm down $89. So nothing really to speak of. And so we still have 30 trades to go. Maybe it will turn around. I don't know. I mean, that's, it's not unusual to go sideways for a little while. And we'll see whether or not this particular trade has a place in our overall, stable of strategies. And after this is done, we'll come up with another strategy hypothesis, and then we'll try that. And we'll put 100 trades out to let everybody see what we're doing and whether or not that has viability too. So if you want to, learn about strategies like this and how to play that final hour, this is the perfect place to be. So yeah, I really do think that we're settling. That I'm becoming more and more convinced that 42.75 is going to be the final resting place. All right, so now the only thing that's left to do is to take bets. So I have to ask everybody, what is your EOD call? Mine is 42.75. All right, so we have a few more stragglers that came on. We have, how you doing, Mohammed? Nice to see you here. All right, let's see, Nick Bourne paid $8 to pin 42.50. That's pretty expensive. Bought SPX 42.65, 10 wide for $1.35. Yeah, that's possible. It doesn't look like it's going to get down there, though. I think that everything's sort of settling out, and yeah. Multiscan agrees with me. UGuest is guessing 42.90. Vadim says, hey, Ernie, you mentioned yesterday an adjustable iron condor strategy that you're pondering. Care to elaborate a bit, please? Yeah. So let me just go through this here. We have one saying 42.70. Mohammed saying 42.70 as well. Augustin Prini, that's interesting name. He says 42.83. Very specific. No, I mean 8 cents. Okay, that's better. Because $8 for that trade, I would say, you crazy? That's nuts. All right, so Vadim's asking, what's the next experiment going to be? All right, so Nita wants to know, when would you use puts and when would you use calls in this strategy? Well, for a symmetrical butterfly, it really doesn't matter, particularly with the SPX, because there's no assignment. And the difference between a call and a put fly are maybe pennies. So it really doesn't matter. There is an edge case that we have if we're wildly wrong and we want to remove the short strikes and for a potential better trade. But, that really doesn't come into play. So it literally does not matter if you go puts or calls. But by convention, we just make the flies a put if it's a bearish trade and a call if it's a bullish trade, bullish direction trade. But it's not really necessary, really. It literally does not make any difference on the performance of your trade, regardless of whether you have legs in the money or not. Because it's the SPX and because it's cash settled and there's no assignment, your account is credited or debited on a cash basis only. So that's why it doesn't make a difference. All right, so for Vadim, he wants to know what this new strategy is. Of course, we're not going to do it for 30 more trades, so it's not even going to come into play until September sometime, I would say. Yeah, about September. And my idea is to start with an out-of-the-money iron condor, and then whether or not price moves towards us or away from us, we would roll the weak side and collect that premium. So by rolling the weak side and collecting the premium, we would keep on doing that, and that would then eventually turn into just an iron fly. And if price is going towards us, that's great. If it's going away from us, there might be some other adjustments that we can make there. The only problem I have with that strategy is the cost, because each roll is going to entail a cost. It's not going to be a huge cost. It'll be about, maybe $1, $1.20. I mean, literally $1, $1.20, because in most places your SPX per contract commission is going to be about 65 cents, and of course there are the exchange fees too. So that's basically it. So we'll put on an out-of-the-money iron butterfly, or iron condor, sorry, and then depending on whether or not price moves towards it or away from it, we will. So if it moves towards it, we will roll the far side. If it moves, let's see, no, that's the other way around. If it moves towards it, we will roll the near side. If it moves away from it, we will roll the far side. So that's the premise. Jim wants to know, Ernie, do you ever look at SPY options volume? Yeah, but we're not trading the SPY, so it doesn't really matter. And, trading the SPX is fairly liquid. I know that the SPY is much, much more liquid, but it's a smaller index and there are a lot more people in it. But you're not going to get any different information. Actually, it's a little more granular, or not granular, less granular, because it's 1/10 the size of the SPX, so you don't get that granularity of levels. So for me, it doesn't really make sense. And really, the only way we're going to do any kind of analysis is with the E-mini. It's the best choice, because there we have the full size of the contract, the full size of the price space, and we have volume, so we can look at the volume profile. So for those reasons, I'm not really interested in looking at the SPY. All right, let's see. Do you always close the trade before expiration? Is there a downside to leaving the trade to expire worthless? No, there's no real downside. In fact, you may even save some money by letting it expire, depending on your broker. Some brokers will charge you a fee for letting it expire. There's no assignment, and so it really doesn't make a difference. The only real thing that you have to watch out for is that when you're right down to the final minutes, a lot of times volatility will kick up, and so your gamma risk will increase dramatically. So the value of your options contract will be very, very sensitive to any kind of price movement. And so that might be a good reason to get out before expiration. However, if you have a wide enough spread on your fly, then it shouldn't make a difference. Shouldn't. But we have days like yesterday where it just fell off a cliff, where it wouldn't have mattered where it was. So in general, I like taking the profit before expiration, but there's no penalty that you get for not doing that. Is the weak side the far side vertical? So maybe saying the weak side was the wrong terminology. What I'm saying is you would roll the side that increases in value. So in other words, the side that would generate profit. So if let's say that it's an iron condor and it's a bearish directional trade, so it's on the downside, and price starts moving towards it, then the far side is not going to be increasing in value. It's going to be decreasing in value. The near side is going to be increasing in value, right? Because of that spread, it'll be increasing in value. So when it increases enough, you want to roll it and capture that profit that it created. And now the whole strategy now, because you've captured that profit, has reduced your risk. And so now your potential profit has increased even more. So now the one that you rolled has even more potential profit in it. And if it's the far side, if price moves away from it, then you would roll towards price, because what you have done is you're capturing that profit and then rolling it up, and then basically it's the opposite story. So I'd like to try that out and see whether or not rolling it right into an iron butterfly will afford us any kind of advantage, and if there's a strategy around that. Give us an earning play? No, we're not doing earnings. Sorry. Thank you. What would be a 0 DTE iron condor or a longer expiration one? Well, I don't know how wide to make the iron condor. I haven't thought about that yet. It comes down to how many times you might roll. So I don't know. You might make the short strikes maybe 2 to 4 strikes apart. That would give you 2 to 4 strikes to roll to. So you could roll a full 4 strikes, or you could roll any increment of that. So I think that would probably work. It really would come down to how cheap I can put that condor on from, and how little risk that I can have up front with that trade. So I still want to look at the risk to reward. So if I can put it on super cheap with plenty of potential profit, and I can capture the profit as price moves towards it and increase the potential for a pin, that would be my goal. All right. Is sold for 280. His. Okay. Left a ton on the table. That's okay. Taking in profit is good. There's always tomorrow. We're still moving down. We're right at the 42.75. We only have 8 minutes to go. So let's bring the chart up. So my call was for 42.75 as a finish. Let's put an arrow right there. Give it a different color, like a purple color. That's my call right there. Let's see, what was the open at? 42.69 was the open. So the open was way down here. All right, who's going to win? Well, I'm looking at all of the guesses, and so far I am the closest. It's your chance here. We have 6 minutes to go. Of course, this is a no trade today. And the only reason I wasn't able to take a trade, so let me explain. Now, when we first started on here, price was a little further up here, and it moved down rather quickly and moved right into this area. Now it started to consolidate. After doing the analysis, determined that this where it moved down to and is consolidating is likely going to be the place where it's going to end the day. And so because of that, I'm not able to get the kind of risk to reward that I need in order to make it a viable trade. So I decided to skip this trade. So if you were here yesterday, then you would have seen that we came very close to a pin trade. And the day before, we also came close to a pin trade. And Friday, we also came close to a pin trade. So that means that a lot of profit was potentially made over the last 3 days. And then on Thursday, I believe I had a small zero DTE trade, not a zero DTE trade, I'm sorry, an XSP trade that I pinned to within a penny. That was crazy. So it's kind of interesting that all of a sudden the hit rate is going way up at this point in time. The initial moves of this bear market rally were extremely difficult to call. There was this disconnect between what was happening and what was happening in the market and what was happening in the economy. So, all right. So we have a question: what is a pin trade? So a pin trade with a butterfly. Here, I'm going to explain with. I am going to explain with my iPad. How's that? So what we'll do, all right, the iPad is on. Here's the iPad. We'll create a new chart. And we're going to create a risk graph and then a butterfly. Oop. I want that to be this color. All right. And then I'm going to also create the profit curve. Usually it looks like this, right? And then over time it grows until it finally fills the fly at expiration, the cyan line being the at expiration. All right. Now, a lot of times we make profit simply by closing trades outside of the fly before the market closes. So a lot of times we can close a trade right here and make as much as 150 to 200%. Now, every once in a while, about 10% of the time, price will move inside the profit tent and close in an area that's, say, within 5% of the center, or something like this, somewhere in this range. And if we can close a trade inside of here, very close to expiration, where we can take profit anywhere up in this area, we call that a pin trade. And that gives us almost the maximum amount of profit. Now, if you look at this, most of our trades are 1 part risk to about 8 parts reward. So if we paid $100 for this trade, and we were up here and we got most of that potential reward, that's often something like worth $600 to $750. That's what we would call a pin trade. A perfect pin would be one that we came right at the center strikes. That would be maximum. And that's what happened to me last week. I came within 1 penny, about as close as I've ever come, and got the maximum reward for it. So that's what a pin trade is. Hopefully that answers your question. Anton wants to know, could you please talk about the services that you offer? I want to join, but I'd like to know what to expect. So the service is all about coaching and mentoring on being an options day trader. And we focus all of our trading around a particular strategy because it has excellent profit characteristics and excellent characteristics for somebody, well, for any trader, actually. Using the butterfly is one of the most flexible flexible strategies to use anywhere. And so the concept that we have is taking very small risk or asymmetric trades with small risk, large potential outcome. And so the service itself is all about that, learning all aspects of trading, from the planning, journaling, the mental aspect, to the strategy, the methods, the process that we use. We use a kind of continuous improvement process that encompasses the whole thing. And so it is, and that's basically what it is. We have about 650 people in our trade room. They're all like-minded traders. A lot of them have been here for, right from the very beginning. And they are, becoming expert in this strategy. And so there's a lot of help here. I provide coaching and mentoring for every individual. This is unlike any other strategy or service that you'll ever see. You'll never see a proprietor so involved with his clients as I am. So in that, every single member of our service gets my personal mobile number. They are all entitled to personal coaching and mentoring. My goal is to make every person successful and really learn the art of trading, the art and science of trading. So we're not just putting out alerts and then putting you on your own. It's nothing like that at all. And you can ask questions. We have live streams every day, live streams that are instructional. Besides this one that we're doing here. And then every week we have a review process where we all get together, and we call it the retrospective. It's on the weekend. So that's basically what the service is about. And for the price, it's just crazy, crazy cheap. For a whole year right now, there's actually a special this month. If you were to join for a year for this month, it's only about $515. Normally, it's about $915. Even that is crazy cheap. So that's what the service is about. Hopefully that interests you. Yeah, so was I right? I was talking right through it. All right, Iz wants to know, can you start tracking how frequently you allow a trade to expire in the money? Pin trade in the tent and allow to expire. I don't know that that's that important, to tell you the truth. I don't know what the value of that is. The only real value to us is the return on capital. What is the return on capital? The return on the money that we're putting to work. What is that? That is your ultimate measure. We're putting on trades that will maximize that through that asymmetric setup. And so where it actually ends up, we don't care. We know that landing a pin trade is a relatively rare event, only happens about 10 or 15% of the time. So if we can put on trades that will 10 or 15% of the time land there, you're going to do really, really well. And if you can also have some level of distribution of trades, that are small losses and small wins, and then the spectrum of trades between that and pins, you're going to really have an incredibly successful career trading this strategy. So that's all that really matters to me is return on capital. Richard said earlier he was saying 4,300. Anton says, thank you for answering my question. How much capital should I have in mind for my account? Should I be in front of my computer a few hours, or how is it going to work? So we have a 4-week trial. It's $19 a week for the 4 weeks. If you join, then you get all of that back and then a big discount on top of it right now. I'd say that, there are people with accounts as small as a couple $1,000 to people with a couple of $1 million. So it really, you can make it work. I have to caution you though, when you start with a small amount and you're just starting out, then you should take it easy at first and trade super small and super tight until you understand the strategy and you start building up on your skills on the basics. And we put a big emphasis on that it's very important that you understand the process, the strategy, the methods, and then employ very risk-averse trades and then build from there. And once you feel comfortable with that, then you can start expanding a little bit. Nothing is going to happen overnight with our service, and that's the way it should be. You're going to learn how to be a professional trader if you stick with it and you want to do the work. Now, how much time that you put into it, that's completely up to you. You can put, just monitor your trades every once in a while and go that route, or you could be a full-time trader. We have all different types. We have some people that are onto this full-time, others that are working a job, and others, this is an alternative strategy to things that they're already doing. So we have all types here. And we have new traders, and we have professionals that are here as well. So it's a really good mix. What does it cost monthly? Well, I have a yearly cost that is way cheaper than going monthly. But if you wanted to do a monthly, there's an upfront cost of a couple $100, then it's $74 a month. But if right now in the month of August, it'll cost you about $515 and you'll have a whole year. It says that makes sense. Just need to manage the profit. That's what I was curious about. Those pin trades, they pin at or near expiration. Yeah. And Luke says, how scalable is trading like this? I.e., how many files would be open relative to an account value, barring how many flies would be open to an account value, barring the amount of risk and trade you'd be willing to take? Well, first of all, I would say that we trade way smaller than you could possibly imagine. And with the size that we trade, it really depends on, your account size, obviously, and your tolerance or capacity for risk. But generally, it's going to be a lot smaller than you think. Some people come into here and think, oh, man, this strategy is unbelievable. I can make all this gobs of money if I pin a trade. And then they come to realize that the pinning of a trade isn't like an everyday occurrence. You could have streaks where you make a pin trade, several in a row, but in reality, it only happens about 10 or 15% of the time. What you're doing is you're going after those meat and potato trades and then getting those long tail risks that will fall in line every once in a while. And those are the things that really elevate your account. The important thing is if you trade small, you're going to have very small drawdowns and your account is going to slowly move in the right direction. So that's how you want to look at it. I mean, I trade, well, let me just show you some performance numbers, all right? So you can see. I started keeping track of everything just for this purpose over the past couple of months. I kept track of everything I did last year, but I was doing a completely different thing. I was trading only the E-mini futures, and I was demonstrating how I could take a small $3,000 account and make it bigger. And in the course of last year, I brought a $3,000 account to about $9,000 using this strategy. Now, I wouldn't say that that's our meat and potatoes way of trading. So now what I'm doing is I opened up a new account. It's a $20,000 account, actually $23,000, and I started keeping track of that. And so let me just show you the performance of that. Hold on. All right. All right. So this is over the past 56 days. And you can see we had some sideways performance, sideways action here. This is all during the bear market rally. It kind of confounded me, to tell you the truth. And so I tightened up my risk a little bit and then just started to grind it out and I'm right at like an all-time high now. But I am up on this $23,000 account in under 2 months, up to about a little over 12%. Is that right? Yeah, about 12%. So about a 52% win rate, which is typical for this strategy because it's a low probability strategy. And but what you're really after is that return on capital. So if we were to look at the distribution of winners here, in the net column, in column J, you can see what it's like. You know, there's a lot of losses, but there are also some big wins. Those are the pin trades. And so what we're really after is this distribution of trades. And so here's how the trades are distributed. You can see we have a long tail of bigger winners. And then we have a lot of small losses and small to medium-sized wins. That's what we're after. That is the ideal trading distribution, because that is going to produce a nice equity curve over the long term that's going to go from bottom left to top right. So I have a simulator that will demonstrate that using all the same parameters and the same performance metrics that I have. And so I could, just keep on. This is for a $20,000 account of over 500 trades. And so every time I press this calculate button, it creates a new instance of 500 trades using all the same basic win rate, range of wins and losses, everything. The same kurtosis, the same skew, the same median distribution, everything. So this is what you can expect if, obviously if you trade perfectly all the time. Not everybody trades perfectly. You always make mistakes. So these might be a little optimized. But this is also taking into account commissions and fees. So it's a very realistic way to look at it, especially when you start getting the drawdowns. That's what the chart at the bottom in red is. That's showing the drawdowns. Now here's the key that you never really have big drawdowns. You can see over the course of 2 years, the drawdown on this instance was only 6.5%. So that's really what you're after. All right, so here's another question. Well, Vadim says singles and getting on base, not home runs. It's actually both. You're getting mostly singles and doubles, and then every once in a while you get a home run. That's how it works. Okay, Anton is asking, what time frame should I be in front of my computer each day? We usually take trades around, we have a live stream from 10:30 to about noontime. And that's when we are usually taking the trades. And then from there, you can monitor it. And then when you're ready to take profit, you just take the profit. It could be any time from there until the close. Really depends. But most people that are working are just simply monitoring it on their phone. And then when it's getting close to their, the place where they think that they're going to get their max profit, they'll just execute the trade. Well, we will set up our exit trade prior to anything else. So once you put on the first trade, your position, you should put on your exit trade so that you don't have to fumble around with it. So that's basically how it works. I don't know if this will work out for you, Anton, because it sounds like your job may interfere. We don't really put the trades on too much earlier. It's between 10:30 and 12:30, I'd say, is when 90% of the trades go on. It's possible we could put one on earlier, but that's when we put them on. All right. Looks like hopefully we answered everybody's question. And if that's so, I want to thank you very much. We'll see you tomorrow for another final hour trade. Hopefully we can make a trade tomorrow. Regardless of whether or not we make a trade or not, we'll still be talking about trading and these strategies and how asymmetric positions are really the way to go. If you think that high probability trades are actually serving you, think about it. Are they really? Sure, you can do high probability trades and make these tiny wins, but then every once in a while you have to deal with these huge mammoth losses. Actually, most people are dealing with them all the time. And you're constantly forced to manage this risk. I like to say manage your losers, because that's actually what you're doing. We have flipped that whole equation where we're never really managing our risks at all. That's built into the trade. What we're doing is we're managing our profits. So it's a fundamental difference. It's really the way the pros trade, not the way retailers trade. The way retailers trade is the high probability trade. The way pros trade is they take small risks for huge outsized returns. And that's what we do. All right. Thank you very much. We'll see you tomorrow. Have a good one.